Welcome back, investors, to Ticker Time News. I'm Adam, and despite bumping up its Q3 22 and fiscal year 22 guidance higher, buy now, pay later company Affirm, ticker symbol AFRM, is getting hit pretty hard, continuing a dreadful slide that has seen the company's stock plunge by 80% or more since last November. Slowing growth and rising competition in the buy now, pay later space have primarily been to blame for Affirm's recent demise. But now there's a new problem that has emerged. But before I get too far into it, beat this crazy market with us by clicking the first link in the description. Okay, last Friday, Bloomberg reported that Affirm was forced to halt an asset-backed security, or ABS sale, due to a large investor pulling out of the deal. In addition to forward flow arrangements in warehouse credit facilities, Affirm uses ABS sales to fund its buy now, pay later services. So, news that the company was unable to close this transaction spooked investors badly, creating concern that volatility in the ABS market will hamper its ability to raise capital. An alarming aspect to this development is that the tranche within this ABS security that didn't completely sell is the highest rated portion of this instrument. If the investor in question was worried about defaults rising in this tranche, it raises serious questions about the riskiness of the lower quality tranches in Affirm's ABSs. The fear is that other potential investors will look at this decision to walk away as a major red flag, creating a snowball effect that results in significantly higher financing costs or wider risk premiums for a firm. Aside from this issue, the sharp rise in interest rates is putting further pressure on Affirm shares. The company's split rate arrangement with Shopify is particularly exposed to interest rate risk on the revenue less transaction cost metric. During the Q2 earnings call, Affirm's CFO addressed this topic, stating, quote, taking on a split pay product of 5 to 5.5% merchants fees, you're not going to make 4 points of margin. And you do expect a little bit of compression on a percentage of GMV based on the split pay business, end quote. These negative items are completely overshadowing the good news that Affirm has shared. First, fueled by the company's partnerships, mainly with Shopify and Amazon, gross merchant volume, or GMV growth, remains strong. Affirm now sees Q3 revenue of at least $335 million versus prior outlook of $325 to $335 million. On the higher side, in fiscal year 22 revenue of at least $1.31 billion versus prior guidance of $1.29 to $1.39 billion. So again, on the higher end. Second, operating expenses have trended below expectations, allowing Affirm to nudge its adjusted operating margins higher. For Q3, the company now expects adjusted operating margin at a loss of 15% compared to its former outlook at a loss of 21 to 19%. And third, Affirm currently has abundant funding sources with the ability to fund more than $20 billion in annual GMV, and committed funding is trending better than the company expected. The problem is that Affirm was already deeply out of favor before this ABS sale was halted. Those darkening clouds that investors see on the horizon only became more ominous with this occurrence. At its core, Affirm's troubles are linked to a sense that rising interest rates, persistent inflation, waning consumer confidence, and an unstable geopolitical environment are setting the stage for an economic downturn that will hurt its business. Well, that's what I think about Affirm's latest news. What do you think about it? Let me know in the comments below, as your comments really do make these videos so much better. Smash that like button, share this video, and beat the markets with us by clicking the first link in the description. And if it's your first time watching, click subscribe. For Ticker Time News, I'm Adam. Thank you so very much for watching, and I'll see you in the next video.